everybody. We should start having people come in. Everyone should be muted and with their video off. If you're coming in and for whatever reason you have your mic on, please mute yourself. And if everyone can open up the chat and please introduce yourselves in there. And we'll also be doing a Q&A towards the end with our speaker, Jim. And you can ask him some questions about fundraising or investing or founders and what he looks for in startups and whatnot. But I'm very excited for this interview today. Jim and I had a conversation, I think it was a few weeks back, and I really enjoyed what they're doing with their new fund. And it's something that it's a very unique approach to raising money and investing in companies. So we're going to get into Jim's background at FirstMark Capital, which is one of the, in my opinion, the top VC firms out there right now. And we'll be talking about his whole story going from Princeton to Insight Venture Partners to FirstMark to now, starting his own fund and also doing some angel investing as well. So we're going to give it a couple more minutes here to let some more people come in. If you're just joining us, please introduce yourself in the chat, where you're from. And if you have any questions for Jim, please feel free to message me directly or just throw them in the chat there. And we'll kick things off here in another minute or so. If this is your first time joining us, my name is Michael. I'm the founder of Entre. We're a social network for the future of work. So I'm going to pull this, actually is going to help out. I'm going to share my screen here real quick. And there we go. Here's Jim's LinkedIn if you want to connect with him. And let me pull this up here. So if this is your first time, like I was just saying, we're creating this new platform because we strongly believe that the future of business networking and the economy is going to look a lot differently. And we're starting to see this transition already happen, and a lot of people are transitioning from the 9-to-5 lifestyle, corporate careers, salary jobs, to what is small and online businesses, freelancing and gig work, and startups and technology. So we're building the platform to connect and support all of these people. So here's a little, a bit about the app that we just started rolling out. So there's a couple thousand entrepreneurs, investors, and freelancers on here right now. You can create content very simply, ask questions. You can create posts with images, links, all of that. You can have cool conversations with other entrepreneurs, get feedback on your ideas, launch your product, and all of that. You can also easily search for who and what you're looking for with super simple filters. So if you're looking for investors in AI, you can very easily sort them in 2 clicks, and you can connect with them and message them just like what's shown here. So our whole goal is streamlining this process, making it super easy to find who you're looking for, create a very simple yet modern approach to, to this new business platform. And then finally, we have Entre Pro, which is our premium, which gets you free tickets to all of our events, gets you deals and discounts with all of our partners, like on the screen here, can save you hundreds of thousands of dollars on software. And we're also going to be rolling out a bunch of in-app features as well. So here's some of our upcoming events. Tomorrow, we have a deep tech funding panel with 2 really great investors and Eagle Point Funding. Thursday, we have another investor interview. He's an angel investor and also just started a new fund, Reinforced Ventures. And we also have a Leaders Live episode with Brian from Lightship Capital as well. And we're here to support you guys. So if you need help, whatever, feel free to reach out to us. You can sign up for free at joinentre.com. If you hold your phone up right now, you can download the app. It will go right to the app, so you don't have to search for it. And then if you text us, you'll get a free ticket to any of our upcoming events. So if there's any events that you guys want to come to, just shoot us a text, just say hi or hey or whatever, and let us know what event, and we'll shoot you over a free ticket. And without further ado, Jim, I'd love to have you come on now. And I think I love starting with, your background. Like I mentioned briefly earlier, you've done a lot of really cool stuff already. You've had you've been VC almost in investing almost a decade now, and you're still like very young. So it's a very impressive background, and I'd love to have you share more about your background and then where you guys are at right now, and then we can talk more about it later on.
Yeah, sure thing. First of all, Michael, appreciate you having me on here. Really excited to talk to you and a bunch of your audience. I think what you're building is super cool, and it speaks a lot to the trends that we saw that we see in entrepreneurship around just better connectivity, democratization of like knowledge, of financing, info, all that kind of stuff. So happy to be a part of it. Can everyone still hear me okay? I noticed a few comments in here that people are affected by this tropical storm on the East Coast. I am as well, which is why I'm taking this from my car. Can everyone see it here? Okay, good. Great, yeah, so I'll talk a little bit about my background. So I spent my entire career as an investor, which is actually kind of an unusual thing by now. I think in maybe 5 years' time, it won't be so unusual. But I was at Princeton for undergrad. And then while I was there, I did an internship at Inside Venture Partners back when they were maybe 3 or 5 billion of assets under management. Now they're like 20 billion plus, an enormous firm even back then, and even more so today. So that was a classic growth equity, one of the first growth equity plays in software and internet. They've done obviously tremendously well. So that was my first experience out of college. Had no idea that was going to be my career, fast forwarding all the way to today. But it was an excellent place to start out. I can't thank them enough for a bunch of those opportunities over the years. Sort of the track for me was starting as an analyst there, where the job was mostly outbound sourcing for companies for insight to invest in. I worked specifically on a team there that was really interested in bootstrapped, profitable software companies that were not in your major metro areas like New York, California, or Boston. And so pretty early on, I learned and I came to appreciate that there's a ton of businesses out there that just don't get the tech press, the recognition, the funding of a lot of the things you see just opening up Twitter, for instance. But that many of these businesses are incredible, valuable entities where people have put their blood, sweat, and tears, and not a lot of outside capital into building these amazing companies. And Insight was lucky enough to back several of them. So Pluralsight comes to mind, of a business in Utah that started off as sort of classroom-based learning, and now is a big public company. Insight was one of the first pieces of capital into that company when they're already sort of growing and profitable. Qualtrics, they got a piece of also, which was doing really well. And you've probably seen the news lately that Qualtrics is now going to spin out from SAP in its own IPO. And then another example that's not in the Insight portfolio, but is I think fairly well known is Atlassian. So Australian company that never raised primary capital. They did sort of like a pre-IPO liquidity round before going public, and they're one of the highest trading, highest flying companies out there. And so the general thesis that Insight had was that for this particular strategy, if you find these companies that have done a lot with a little in terms of capital, then they tend to have really good habits of how they can scale and service their customers really well and market really efficiently and become big businesses. And so I did that as my first job out of college, almost a decade ago, and I never really lost that appreciation for that type of company. So after 2.5 years at Insight, I went to a firm called FirstMark Capital in New York City. Michael did a really good interview with Beth Ferreira, who's one of the partners there, and who I worked with when I was at FirstMark. So FirstMark's one of the top sort of early stage East Coast, specifically New York-based firms. They have done a tremendous job over the years in software and internet and consumer and hardware. They're really a top-notch firm with some really great people there. Pinterest was one of their first investments, and they were one of the largest investors there. And Pinterest is now like a 10 billion market cap company or something like that. They also backed Shopify, which has obviously exploded beyond anyone's wildest imagination from IPO. So at FirstMark, I would join there as an associate. Ended up working there for almost 4 whole years, mostly doing board work. So FirstMark is a model where they lead or co-lead most of their investments, and they're very active on the boards. And so I got to be involved with probably 20 to 25 different companies at the board level, which was an amazing experience. Most of those on the B2B side, a handful of those on the consumer side as well. And through that time, got to really see the inner workings of the boards of companies, some of the important decisions and discussions that get done there. And also getting involved with quite a lot of financings. So that's, us at FirstMark, when we were investing in a company, that was when we were insiders in a company and helping the startup evaluate their next funding round, and everything from getting their financials in order and their KPIs to thinking through like the major milestones around hiring people and getting salespeople up to speed. That was an amazing experience. However, I don't recommend that anyone take on 20 to 25 different boards. That was cool learning, but it was a little bit tough to do much other than boards when you're on that many. And then while I was at FirstMark, was an angel investor as well. So after a few years of sort of doing it for others, I thought, I'm going to toss a little bit of money here and there and see what it actually feels like to sort of be the person to pull the trigger and make investments. So I got to back actually a lot of my ex-Insight colleagues who had branched out and done other things. So I got into Carta, which has been doing pretty well. Backed another friend who's doing a business called Eden Health in New York that does that's doing really well right now because it's a hybrid telemedicine and sort of in-person medical service packaged as a B2B company. Backed a few of my friends who are doing consumer companies as well. And then fast forwarding all the way to where Reformation is, and what I'm doing now is after a few years at FirstMark, I just started thinking back to the roots of my career in venture and private equity, specifically thinking about what it meant to bootstrap a company nowadays versus back when I first got into this industry. And then that combined with a lot of the trends I was seeing just day to day inside of a really good firm is I see some amazing businesses that were growing really well, often break even to cash flow positive at a very early stage, and had the potential to be like an Atlassian or Qualtrics type of company, and yet for various reasons we're not actually that interested in going down a venture path, either with us at FirstMark or any of the other storied and very well regarded firms in the Valley and in New York. And I started to talk with my co-founders who were my colleagues at FirstMark, and now we're building Reformation together. And we just started seeing more and more of this trend of businesses that were really awesome companies, but either because the VCs couldn't make the math work on like a venture outcome, or because the companies themselves decided that I don't know if the venture path is necessarily for me. And we just felt that this was a huge, growing and underserved market. And then after enough kind of talking and coffee walks and all that kind of stuff, sharing our experiences across boards and across like company diligence cycles, we realized that there was a bigger opportunity to go build a firm specifically for this segment of the market. So that became Reformation. We left FirstMark across from 2018 to 2019, the three of us, and we'd already been working together for about 4 years there. And then graciously got the backing of the founders of FirstMark also, in addition to a bunch of really exciting folks to be partners in our business. And we built a firm now that's specifically going after that opportunity. We think it's a huge opportunity. We're seeing a bunch of amazing companies, and often what we're told when we reach out to companies or get introduced to them is that we're sort of this breath of fresh air, where we can pay a lot of attention to companies that decide for themselves, like, hey, I don't know if VC's for me, I don't know if venture debt's for me, but I definitely want to build a big business, and I want to own a bunch of my outcome, and what you guys preach is resonates with us, and so that's what we're doing now.
Yeah, no, I think it's fantastic, and it's one of the reasons why I wanted to do this, because I think your story and what you're doing now is so important with all of it. And I'm glad you went through the whole thing there. Also, I just had a little internet trouble with my laptop, so I joined on my phone. I know Jim and I are both kind of going through the same thing with the hurricane here in Jersey and Philly. So hopefully, I think we're good right now, and everyone should be able to hear me and everything. But Jim, I'd love for you to share a little bit in detail right now what Reformation is doing. I know you obviously went through it, and it's different type of VC, but if you want to break it down and just explain to people what is the difference between this new way of funding that you guys are putting together, and obviously having the backing of FirstMark is awesome, and having the team that you were working with there shows a lot of the credibility for it. And I think it's something that a lot of founders should look into doing if it's the right fit for them and if it makes sense. And like you said, they want to retain their equity and all this stuff. So I think it'd be great if you could break it down a little bit, just so you can help, so people can kind of understand, what you guys are doing with your new fund.
Yeah, sure thing. So as Michael alluded to, we are investing a little bit differently than your classic VC. So as a little bit of background, one of the things that I think we really came to understand well in our previous lives as VCs is the instrument of investing itself. So for the past 50 years or so in the VC industry, the main product, if you call it that investors are selling is a preferred equity financing or derivatives thereof. So a convertible note is essentially something that becomes a preferred equity type of stock. A safe is literally that, right? An agreement for future equity. And so one of the things that we came to understand well is what it means to take preferred stock in your business. And the simplest way to describe it is if I'm an investor and I invest basically preferred stock in your business, the way that I make my money as an investor is that eventually someday somebody buys that stock off of me for a major appreciation. There's other ways to make money on stock, like if it's a dividend stock and if you can use leverage around that, like some of the later stage private equity firms. But generally speaking, for VCs, their business model works on buying stock in a business and then selling that stock at a later point once there's a bunch of value appreciation. So what this presupposes for the VC business model to work is that companies have an exit, and usually a pretty large exit too, within a certain amount of time. So so with preferred stock, whenever you raise preferred stock, there's usually a conversation, explicit or implicit, with a VC that's like, hey, how do we position this company for really big, really valuable exit someday? And usually, the building blocks of that are executing really well, making your customers super happy, having best-in-class products, very tight, network effects, all those types of things. But all of those put together, plus growth and some luck along the way, hopefully results in like an IPO, hopefully results in a big strategic acquisition that can return an investor 10 times their initial investment to sort of compensate for the risk of getting in very, very early. So one thing that is sort of missing from the equation of VC is what happens if a company decides at some point that I don't know if that's for me. I don't know if I necessarily want to build toward like a really big outcome in a defined timeline. Maybe an entrepreneur thinks I want to build like a really big, really profitable company. And if somebody comes along and says, hey, I'll buy you for a huge amount of money, then like, of course you'd say yes to that. But if that doesn't happen, if you're comfortable running like a really big, really valuable company that has a lot of profits attached to it, you can make the case that VC is probably not the right path for you, especially because people are looking for particular outcomes along, in a particular time frame. So when you take on preferred stock, that's one thing that you always want to keep in mind. The other thing that you want to keep in mind is that it also goes to how the VC business model works. So as a VC myself, I also fundraise and similar to all the companies that I work with too. And in order to fundraise, at the core, the the case you want to make is that you are a better risk-adjusted return on capital than investing in the stock market, keeping your cash in the bank account or under your mattress. And so for VCs, the thing that's in the back of their head is obviously the returns can be really, really big if you hit like a Facebook, et cetera, and that should be attractive for outside investors. But that also needs to be weighed against the fact that honestly, a lot of startups don't really, have huge cash outcomes. And so, obviously there's high failure rates, plus the fact that there's a bunch of illiquidity in this world means that if you deploy $1 into a venture fund, maybe after 10 years, it's marked at 5 times or something on paper, but you may have only seen $2 or so in returns. And so that dynamic of illiquid early stage private investing usually drives VCs to look for things that can create a bunch of value really quickly and go for really big outcomes, because that compensates for the fact that you can be very illiquid for a very long period of time. So what that means for companies is actually really important, and I'll take a little bit of time to explain this. So what that means for companies is that you need to be growing pretty quickly to get a VC excited, and also to keep your VC sort of aligned with you on what the outcome for a business is. And so you might have heard some things out there, especially in enterprise software, where you want to like triple your revenue in the early years and then double it every year after that. For consumer business, it's benchmarks that say, depending on your market, you should be like 10 times within 2 years, assuming you have like the marketing spend, the unit economics to do it. And so this is a very particular way of growing a business. And as part of that, the VCs typically need you to be fundraising a lot, so you continue to have liquidity, you continue to have capital go for a big outcome, and also so that the VCs can continually show this appreciation of their stock on paper, so that's their report card essentially back to their own investors of like, see, look, like the portfolio is working, you're not seeing a lot of liquidity yet, but the paper value is growing very quickly. So if you're a company that thinks to yourself, like, I don't know if that's necessarily for me, and I'd like to build a business that might take only a little bit of capital in the early days and then run profitably as long as it needs to run. There's an argument that isn't always the best fit for most VCs out there. And we just started seeing so many of these companies that we at Reformation wanted to sort of examine the preferred equity dynamic of venture and see if we could do something a little bit different. So we are investing, as Michael alluded to, on a slightly different instrument. And instead of going into like all the details of it, I'll try to summarize it in super basic terms as like hybrid equity and debt. So, and it behaves differently based on how a company grows after they work with us. So we have a $20 million fund. We're trying to invest about $500,000 to $1 million at a time. And the companies that I think make a bunch of sense for us are generating revenue. So I don't think for our model we can do pre-revenue businesses. We're still sort of toying with what the right revenue thresholds and other metrics are, because honestly, we're a pretty new firm. I've only been doing this since January. But the goal is to back companies and say to them, hey, if you want to, like, here's your working capital, you can build a business with this, and you get a partner who's done this, many times before, and who can be really actively helpful in the business. And so we'll say to them, look, if you want to go the traditional venture path, just make sure you know what you're getting yourself into. It's usually a lot of time spent fundraising, a lot of time spent on investor relations. Raising at a certain valuation typically means that you won't be exiting at a valuation around that point. And so much has been written about sort of the trade-offs with VC, and one of the opportunity costs is that if you raise $100 million valuation and someone comes along and says like, hey, I'll buy your company off you for $50 million and you own 60% of the equity, that's it's life-changing amount of money. And oftentimes your VCs will discourage you from taking that, or they will have actual preferred equity blocks in there so that's not a possibility. And that's understandable given that the VCs are underwriting you to a really big return. So what we tell companies with our instrument is, if you want to go for a really big VC, outcome, that's fine with us. But if you don't want to get on that like treadmill or hamster wheel just yet, work with us and continue to bootstrap. Maybe raise some smart debt capital here and there. And then if you do that, our instrument will function more like debt, so that we are able to get a return on your business without requiring you to fundraise or sell.
Yeah. No, I think it's great. I'm glad you went into the background of it. And I think traditional VC, you were explaining it really well. And I think how I see it as a founder is you get a lot of pressure put on you just to fundraise and, kind of just keep moving things along and, kind of pumping up this balloon that a lot of companies right now, I think there's a lot of unicorns out there that have raised a lot of money that I don't even know if they would be able to sell at the amount of money that they've raised. And I think, especially in the Valley, there's a lot of, it's almost like people put more value on how much money they've raised versus what they're actually really doing and how much they're making and impact that they're having. So it's really funny, but I think, so from your perspective, what companies and what do you look for, I guess, in founders? Because you're investing, even at FirstMark, you're investing in the early stage. With this, you guys are pretty much like seed, right? Pre-seed, maybe Series A level. Is that right?
Yeah, the terminology is always sort of up in the air for what like a seed or Series A is nowadays. But yeah, it's a simple way to think of it. Yep.
Early stage, yeah. So what, and a lot of the time in the early stages, you are betting on the founder or the core team in a lot of senses. What are you looking for in these early stage startups or founders when you're having these conversations with them, when you're reviewing pitch decks, when you're going through due diligence? What are maybe some of the key things that you've uncovered that make for a great, startup, or that you're like, okay, this company kind of checks these boxes and they have a high likelihood of doing really well in the future? Are there any things that you've seen that, from the successes that you've seen, any common threads there? Or what are you looking for when you meet with these founders or early stage startups?
Yeah, super good question. So we are looking for something I think pretty specific, and it's really like I think the main thing that we look for is really like a mentality. There's metrics, of course, and those are important. I can get into some of those, but the real important thing is we want to work with owner operators. So this is a key learning from when we were at FirstMark and even at Insight, is at the end of the day, you're investing in people, even at the very late stages of VC and even in public markets. Honestly, like you typically want to back like your superstar executive teams. So we're looking for people who really take the owner part of it seriously, an owner operator. And so these are people who like and relish the control over the decisions, the rapidity of iteration, that don't necessarily want to dilute just to, for no reason whatsoever. And if they do dilute, they think of it in terms of an owner, which is like, hey, if I'm going to give 20% of my company away, I want to make sure I'm getting people who really feel like owners in the business as well. So that mentality tends to manifest in a lot of different like operational styles. And the main one is essentially like a bootstrapping mentality. So we don't necessarily require our companies to be like entirely bootstrapped when we work for them, but we definitely look for that mentality of like, look, I'm not just going to put money anywhere without doing a bunch of like, rigorous testing, without, using some technology here and there so I can get better visibility and make faster decisions. But we're looking for those folks who think to themselves, look, I want to build something really big and really valuable, but I actually want to own a piece of it upon the exit. And I actually want, I want something to actually want to say in what happens to the business over time. So this is something that tends to get a little bit downplayed in VC. So to give you an example of it, I think the way that we think about it, back when we were at FirstMark and Insight, my partner was at RE for a little bit also, is that if you think of a round as 20-25% dilution, and you do that every 12 to 18 to 24 months, 3 rounds later, you can have lost control of your business, in the sense of, you make the major calls on when to fundraise, when to sell. Essentially what happens at, like, by the time of Series C and Series D is, I think we found some data on this, but like by the time of a Series D, I think most founders are down to 7% ownership. And once you're at 7% ownership, it's not just that you're like, you know, you don't have control of your business. It's that you've essentially ceded control over some of the major decisions around fundraising and sale to your VCs, and specifically to the preferred stock, which has which has honestly like a different set of incentives than common stock, although everybody is, you know, has a fiduciary duty to each other at that point. So for us, you know, we look for people who think I'd much rather go for like $100 million outcome and have 80% of that than like $1 billion outcome and have 8% of it. And even those are mathematically equivalent, the former is like 100 times more likely than the latter. So it's really non-linear in terms of like risk weighting the potential outcomes of their business. We also want to work with people who are very sort of realistic about building and the value of what they're building. So I don't think we would necessarily be a perfect fit for those who are just like super religious bootstrappers, like I'm going to run this company forever, I'm going to hand it down to my kids. Not like many people are building those types of companies nowadays. But if there are, those usually aren't always the best fits for us. So and so when we like go out and explain ourselves, a lot of people sort of grasp the type of company we're looking for, and some people will think, oh, okay, so it's not VC and it's not total lifestyle, but how big is this market in the middle? And like, in our opinion, and some of the facts that we've been able to gather, this market is enormous. And so that's what we're aiming ourselves at, are people who really just think a little bit differently. And the important thing to say is that we're not looking for people who are anti-VC, and we are not an anti-VC type of firm. Like we want our companies, essentially we want our companies to be very thoughtful at the point that they approach VC. So I think a lot of people sort of get into it with VCs a little bit too early and then end up regretting a little bit, where they think, oh man, like I was not ready for that. I did not know that this is what it all entailed. Like, oh my God, that was a huge drain on my time. And I've, you know, given up a large portion of my company by then. And so a lot of what I tell companies is born out of the advice I give to my own angel portfolio, which is like, look, be very, very thoughtful before you really go down that path with the VCs. Do it the way that like Qualtrics did it, the way that Pluralsight did it, the way that like all these amazing bootstrap companies did, where they really approach VC from a position of strength when they already knew what they were, they already had their values set, and it was really just throwing fuel on the fire.
Yeah, I think it's huge. And I agree. I think the market is massive. If you look at some of these companies that you named, and then you add on top of that, like Webflow, Calm, Basecamp, and, you know, 37 Signals, and they just rolled out hey.com. So, I mean, there's MailChimp is a multi-billion-dollar company that I don't think they've ever raised VC funding. And I know VCs have thrown money at them trying to get them to take money. So I think there's definitely strategies. And I think as you are growing your company, if you can produce revenue and cash flow from the very beginning, taking on different types of money and capital to grow instead of, giving up equity is great. That's a great option. So what are the things, what are the industries, companies that you're really interested in right now? Or obviously there's a lot of changes going on, and I'm sure you as well as FirstMark and some of your VC friends and other investors have been really kind of thinking about the world a little bit differently over the last 3 to 4 months, and changing maybe some of your investment thesis, or maybe trying to get into different industries. So with everything going on, and maybe if you can highlight some of the industries or kind of sectors or startups that you're interested in, or that you think are really going to be performing well over the next few years. And feel free to share your thoughts on what everything's going on right now too, because I know there's a lot happening, especially in the investing world. I've noticed personally a lot of health startups getting a lot of funding, and then also obviously some virtual platforms and stuff too. So I'd love to get your thoughts on it, what you're excited about, and some of the different industries and stuff that you're interested in.
Yeah, sure. I'll start with sort of the broader market observations. Not like I have like, the greatest view on all of this stuff, and then go on a little bit of what we look for. So, yeah, I think one thing that's been made very clear over the last few years is just the advantages of technology companies. You look at where the average like SaaS company trades nowadays, and it's basically at all-time highs. And often, actually, if you look at sort of even the depths of March and April, they really didn't take that much of a hit. And that isn't surprising to folks who've been working at home from on Zoom, on Slack, who are still transacting like on Shopify. Those companies have all done amazing. And the other trend that's interesting is e-commerce. So Shopify just did their earnings report last week, and they freaking crushed it again. They're an amazing business. And just anecdotally, and talking to a lot of my friends in like consumer world, it's been, retail has obviously taken a massive hit. And this may be one of the final nails in the coffin for them. Although, I've been predicting the death of retail for a long time and tend to be proven wrong there. But e-commerce has absolutely exploded over the course of this. There aren't great industry reports out on it just yet, but I think you'll see some that really show like how much Amazon gained from this by providing a super valuable service to people who couldn't go to the stores. Even categories from clothes, athletic gear, contact lenses, et cetera, have done pretty well through this, just because of, they have been technology first companies. So those are actually the two areas that we want to focus our fund on the most. So my background is mostly on the enterprise software side. I was probably on a dozen different boards of companies over the years, from very early B2B companies to pre-IPO. And then we also have a practice in consumer goods. So bed sheets, that kind of stuff, based on our experiences at FirstMark, and in our angel portfolios. So the reason that we actually, I'll start with consumer, because this one is an interesting case for us. So one of the things that became clear to us when we were at FirstMark, and even going back to Insight, is that VC isn't a slam dunk case for most consumer companies. I think a lot of people got really excited about e-commerce, and may have gotten a little bit too excited in the investor world, where they think to themselves like, oh my God, these companies are growing so much faster than SaaS companies, because you don't need as much overhead. You don't need to like literally add people to grow revenue like you would in a software company. And so a lot of those got valued pretty aggressively and got a lot of capital pumped into them. But if you fast forward like 4 years from that like 2016 timeframe where a lot of those investments got done, I think a lot of them like are still doing well, but are not going to be like super big value drivers for the funds. And it creates a whole bunch of weird incentives around inside like how to grow these businesses and how to continue to fundraise those businesses. And so one of the things that one of the bolder statements we'll make as a new firm is that we think categorically that direct to consumer businesses shouldn't raise VC. It's typically not worked out very well. I won't go into some of the stories, but just a quick Google search of like direct to consumer companies, VCs, you'll see a lot of sort of a lot of trouble in many of those businesses. However, we think with our structure, where we are basically like a quasi equity, quasi debt type of capital for those companies, I think we sort of have a unique angle in working with them, and making sure that we're always aligned with those companies as they grow. So, and then on the software side, I think we're not really looking for things that are like super exotic in terms of what they're building. Again, it sort of goes to a mentality of how people are building their businesses. So one of the areas that I think we're particularly interested in are vertical application software. And so these are things like, call it construction software, or like compliance software, things that are like very sort of narrowly tailored, but are very good best in breed solutions for their particular markets. And so we like those for various reasons. And one of the reasons we like those is that those are the software companies that tend to be the easiest to bootstrap, because your investments in product are relatively fixed. And what I mean by that is to take the opposite example. Let's say we're investing in like a Salesforce. So Salesforce doesn't work out of the box for anyone in particular. Instead, they rely on a very large network ecosystem of systems integrators who make it work for any particular use case, and they're amazing business because of that. But that's actually a pretty expensive way to scale a company. If you think about it, it's basically variable cost of like configuration for everyone you sell it to, versus like getting really, really good at your particular domain. Let's say it's legal software. It's like, I do this thing in legal so well that my investments in product really have an opportunity to amortize and deliver profits. Those companies are more exciting to us. The challenge, I think, for VCs in these types of businesses is that you typically don't see your way to $10 billion companies in a specific vertical. So counterexamples certainly abound in this, like Viva, for instance, in pharmaceuticals, which has done an amazing job. But you won't find a lot of public companies that are very vertical focused, because there just simply isn't that big of a market for any particular vertical. And so VCs tend to have some difficulty approaching vertical application specific software. But because we have a little bit of a different instrument that we can get our liquidity without companies being like really, really big, I think we can uniquely back those.
Yeah, that's super fascinating. I definitely agree with you in the sectors that you're focused on for sure. It seems like they have they're going to be set up pretty well to weather the storm, regardless of kind of what's going on. As far as the companies that you have worked with and everything, do you have, and there's a lot of early stage founders that are listening to this, and maybe some investors too, but what are your what's your advice for growing and scaling, right? You've seen, people go from, whatever to, millions in revenue and hundreds of millions in revenue, and beyond. What do you have any advice for early stage founders on how to grow and how to scale? Obviously, there's different, depending on what type of capital they take and whatnot, that can change things. But for the companies that you've worked with, do you have any good advice for founders and early stage startups that are watching on maybe some things that they should consider to scale and grow and hit their numbers and continue building their pipeline up and growing to either, continue building their cash flow and or continue to raise more and more venture capital along the way?
Yeah, for sure. So the one thing right away that jumps to mind is really think through what problems your business has that money can solve and the problems that money can't solve. So an example of a problem that money can't solve, and I tend to find there are many more problems that money can't solve than money can solve, is product market fit. So this is a pretty important one, and one of the reasons I think that VC has struggled in certain instances of backing companies before they were ready. So so if like no amount of money can really give you like inspiration for a particular problem that you identify in your market, or a particular product that you think can fix a solution that you feel, what money can do for you though is buy a little bit of time. And so the best way to think about like very early stage capital is like money in exchange for time, essentially. And then you're selling, your company, you're giving some, you're diluting yourself so that you get a little bit of capital so you can get some time and really figure out a problem. Another example of a problem that money can't solve is this idea of brand in a consumer business. So my partner wrote an interesting blog post about this, where one of the things he found is that if you think of some of the most enduring and valuable like consumer brands out there, they tend to have taken a long time to get to where they are. And time is not something that you can, buy just physically speaking. And so you find a lot of like consumer companies that'll try to raise a bunch of money and sort of artificially create that brand through like PR blitzes, through like subway station buyouts, that kind of thing, which can definitely work. And a lot of companies have built amazing brands that way. But it's not necessarily like you put $1 in here and you get brand on the other side. So an example of a problem that money can solve is like, you know that your product works, you know that it makes your customers really happy, you know you're able to effectively monetize it too, and like create and set up your organization in a way that it is a profitable sale for you to make. But there's so much demand out there that your team just can't serve it all. and you just know that like if you raise money, the first thing you're going to do is go out and hire a bunch of people so you can continue to take advantage of this market that's coming at you really quickly, and really show excellence in terms of product and customer service and those types of things. So that is actually classically what venture, I think over the past like 20 years or so, has been designed for. And this is where Insight did an amazing job over the years, for instance, of like, look, you clearly have something that works, like your unit economics, your variable and direct costs are such that like putting money right here into the business is going to do really well over here. Another example of a problem that money can't solve is like a go-to-market strategy. So this is a particular issue, I think, for most of the companies that we look at very closely in that like 1 million ARR range. So to give an example of this is like, hey, we've gotten to 1 million of ARR, a handful of customers, really, happy customers, happy pilots. And like we've built our product, we've sold it effectively. And we have maybe 2 or 3 different use cases across our customer base, and we're really deciding like where to invest our go-to-market efforts so that we can really like turn one of these into a big business. That's actually a really tough thing to do, and capital doesn't necessarily solve that problem. So for example, a lot of companies will start down one go-to-market path and realize maybe that that what they did there doesn't really scale that well. And then they'll have to like sort of pivot and go in a different direction. And those are tough things to do because they're really just honestly like function of time and interaction with customers, and money doesn't necessarily get you more of those. So that's the main thing to keep in mind. I have a few other tips also, but I mean, they're all basically downstream of that advice.
Gotcha. No, I think that's fantastic. And the more and more I interview investors and, also successful founders, the product market fit keeps coming up and up and up, right? It's like one of the biggest things that everyone talks about. Because it seems like that's a big inflection point for a lot of this and hitting critical scale, and mass adoption or massive, taking it to that next level. So I think that was fantastic advice. Real quick, so before we're going to get into Q&A here, so if you have questions for Jim, now is the time to ask them, and just throw them in the chat. And before that, I want to talk briefly about mentoring and networking, right? So if you have had any mentors, how those relationships helped you, and how did you find them? And then what are your tips and strategies for entrepreneurs to network and meet investors and build their team and things like that? Obviously, we're going through a different time right now. So do you have any advice on that? Because I believe it's very critical. A lot of our investors, my partners, our team, I've met through our events and just networking and whatnot. Didn't come really, from my high school or college friends or my family in most cases. So, one being mentors, and then 2 being networking tips.
Yeah, sure thing. So this is one of those things that makes me feel like incredibly fortunate for the amazing people I've been able to surround myself with over the years. I think I particularly benefited from being able to work around some amazing high caliber people at the firms that I've been at, FirstMark and Insight, for instance. But a lot of it is also serendipitous, as you described. So it's getting to know VCs at other firms. It's getting to know entrepreneurs. Actually, we still talk to a bunch of the founders that we were close board observers with for a long time. And because we've sort of been in the trenches in those cases. And like those are just bonds where there's a lot of trust. And hopefully, can be helpful in general. One of the things that I always want to do is pay it forward to young folks who reach out to me, especially when it comes to like how to get into VC or how to raise capital. This is an industry that has a lot of very generous people in it, like very generous with their time. And so I've tried to take advantage of that and pay that forward. Yeah, I think, one person or one firm that comes to mind, actually, you should put on your docket to interview at some point, is So there's a firm in New York called 645 Ventures, and one of the founders is Nnamdi Okike, who was a colleague of mine at Insight a long time ago. So he started a really cool seed stage fund that they're on like fund 3 right now, and have a really sort of unique voice that echoes actually a lot of the stuff that we do. And he's someone that I worked with before, and that I chat with every so often, who's been really helpful in terms of me getting my fund set up. And that's just an example of like one of the many folks out there that we talk to who've been helpful to us. Another thing that we've learned as we go out and fundraise, for instance, as a firm, is that you don't always get what you don't ask for. And so I always recommend to people, just put yourselves out there and ask someone, and you might be surprised at who's willing to spend time with you.
Yeah, I think it's great advice. Do you, how often do you see the correlation of the successful startups versus the people who like really build their network and are constantly meeting people and all of that? Have you noticed any relationship with that? But because there are other people, for example, like Mark Zuckerberg, who literally didn't care to, really meet anyone. He was just building, Facebook, right? It's not like he was like a master networker or anything, at least that as far as I know. But have you noticed anything? Because from my perspective, I'm always trying to meet as many people as possible and build as many relationships as possible. At the same time, you also don't want to just go wide. You kind of do want to also go deep with the relationships. Have you noticed any relationship between the successful companies that you've worked with?
Yeah, it's a good question. I think it's sort of a simple answer, but there's a lot to it, which is just balancing those types of things. So, and actually, like one of the things that I subscribe to is really sort of focusing founder time as the most precious and valuable resource inside of a company. And so I actually sort of goes also to how I think of my role inside of companies when I'm an investor, is like, how can I make sure my founder is getting the most out of his or her time? And so, and also kind of pushing them to do, like, if they're a little bit too product focused, I'll push them to say, hey, like, it might be good to just reach out to this other person in the industry doing something similar, or like, hey, why don't you talk to these folks in like the M&A world for what you do? Like, 30 minutes is probably time well spent with folks like that. On the other hand, like, I'll tell founders also, especially the ones in my portfolio, like, hey, I think you're spending a little bit too much time fundraising here. Like, what I see out there is that this is not going to be a super right market, especially for where your company is right now. Maybe we go back to being heads down and then come back out on the other side. So yeah, the balance thereof is really important. And actually, the piece of it that I think founders can really get thrown for a loop is the amount of time they spend fundraising. So this is one of the observations that really kind of stuck with us in our previous careers, is that the average time it takes to raise a round, like genuinely start to genuinely close, is probably 6 months. And anyone who tells you like 3 months is like, that's a very unique case. And obviously the ones that get written about are like, oh, I opened it up and I got closed in a month. None of that's actually true. The average time is really closer to 6 months. And if you think about raising on a venture path where your runway typically lasts 12 to 18 months before you have to go back out and fundraise again, that's 6 months every 12 to 18 months. That's up to half your time spent talking to investors. And for every minute you spend talking to investors, that's the minute you're not spending with your customers, with your product, really pushing the envelope on what your team can do. Which isn't to say don't ever talk to investors. It's like, be very careful about opening that can of worms. Because like it's very easy to get sucked into that and then pulled in a bunch of different directions of who to talk to and how big of a round you should raise. And so this is where I think like my sitting down and working with companies and really focusing their efforts to so that like, they're not losing that time in building their business. They're not, letting their revenue drop off or their renewals drop off because they're spending, way too much time fundraising. Like it's all sort of a balance, but I definitely have opinions on like where founders should be spending their time.
Yeah, I think no, it makes total sense, and it's the thing that I'm very similar, right? Like I'm very particular about the investors that we've brought on, and the investors that we've brought on thus far, it was like very simple, right? We did not spend any time really going through anything. It was boom, boom. You know what I mean? Obviously, we're approaching the seed, so things are going to get a lot more complicated right now. But I, as a founder, like you were saying, you have to value your time. And if you're spending too much time raising money, then your product is 100% going to suffer, or your service or whatever it is going to suffer, unless you have a fantastic team that can run with it. But no, I think it's fantastic advice. And so we had a question come in too that kind of fits with what you were saying there towards the end about valuation, right? As a founder, how do you know what valuation to take? Because you can go with the average rounds, right? I'm raising between 1 to 2 million, first seed at 6-7 million post, whatever, right? Like you can kind of just go with the average. But do you like people being very, very specific? Like, hey, I'm raising $1 million at 5 million pre, 6 million post, and I'm not gonna raise more than that, or under that, or whatever, right? And how, as the founder, like, do you approach those early investors? Like, hey, I'm raising $1 million, but I might raise more if, depending on who's interested.
Yeah, so valuation is a good question. I'll try to answer this one quickly because I saw some interesting questions. Want to make sure people get a few of them in. So I actually my partner and I both wrote blog posts on this topic in the last 2 weeks. So I would actually recommend that people look up our Medium page. I can't remember the URL, but if you look up medium.com and then Reformation Partners, you'll see a couple of recent posts on valuation. The punchline of it is you want to balance dilution for yourself with downstream financeability. And essentially the way to think about it is like, the higher valuation you raise right now, the harder it's going to be to get that step up for your investors at the next round, which can sort of jeopardize the time and the success of that next round fundraise. But of course, you want to balance that with the right amount of dilution. And then the other piece I want to add to that is when you think about the right amount to raise, I can't stress this enough, do it bottoms up and go to the market with what your number is, instead of letting investors sort of tell you the number. Because what investors will tell you of like what your round size should be, is really more driven by the amount that they need to deploy at a given time to sort of make it work with their fund models. So do bottoms up. Check out our blog on like how to balance like dilution with downstream financeability. That's what I'd say on valuation.
Oh, sorry, I was muted. If you just go to medium.com/reformation-partners, that's the thing. Or if you go to just their website and click on thoughts, it will take you right there.
Yep.
Yeah, I think it's a really important thing for founders to understand valuation for sure. So we have another question here about crowdfunding. So it looks like, yeah, so have you been paying attention to startups going on equity crowdfunding platforms? Like, do you look at Start Engine, WeFunder, Republic, any of these, Seed Invest, any of these equity crowdfunding platforms?
Hey, Michael, I don't know if you're still with us. I think I got your question, your question there around
Can you hear me?
crowdfunding.
Yeah,
I can hear you
sorry.
now.
Hey, sorry.
Yeah.
I don't know what's going on. I apologize, guys. My
problem.
phone's not working and my laptop is. So the question was, are you paying attention to these equity crowdfunding platforms? Like, are you looking up any of the startups on Start Engine, WeFunder, Republic, and using those as a way to vet startups?
Yeah, I don't know. I haven't really operationalized, in the sense that like, can I use these like for our own like evaluations, et cetera. I do think those are really interesting platforms though. And they sort of fit in this broader universe of alternative financing. So I actually really love this just from like a philosophical or ethical point of view. So one of the things that's a little bit funny about the VC industry is that this is one of the last like this is one of the last like middlemen industries that hasn't been destroyed by the internet, and part of the reason for that is SEC regulations that prevent people from investing their own money into startups, and they're particularly aggressive in the United States. Just anecdotally, I know that equity crowdfunding is a much bigger deal in Canada, but yeah, like I think that's a great way for people to sort of get their feet wet, and at least from from the individual investor side. Now for companies, it's also great too, because I think what these platforms are designed for is to really get you like advocates, similar to Kickstarter, which doesn't have an equity component, obviously. But yeah, I mean, it's a great way to like find customers. I haven't done a ton of research on this world. I know Republic is an interesting option, but yeah, I definitely encourage people to look at it.
Great. Well, I know we're coming up on 6, so I want to be, I want to value your time, and I know we're going over here. So, Jim, where can people find you, learn more? Where's the best place for them to follow you or learn more about what you're doing? And how should people connect with you, or if they should reach out, what should they say?
Yeah, so I actually found the URL to our Medium page. So it's medium.com/reformation-partners. So that's where we publish a bunch of our thoughts. I know that my answers are kind of long-winded and windy, and maybe that's because it's been a weird day running around looking for Wi-Fi in the neighborhood. But a bunch of our crisper thoughts around a bunch of these topics, like problems money can solve, like how to think about valuation, how to think about financing path, the opportunity cost of various types of capital, whether that's equity or debt or angels, or bootstrapping, like we've written about quite a lot. We try to publish at least once a week. We've been a little bit bad about that recently, but that's where I think is the best way to sort of get a sense for how we think. And I'd recommend that if people read that and find a few things that are tactical and helpful, and want to chat with us, you can find, I'm Jim at reformation.vc. Our website is reformation.vc. It's not very well built out, honestly, as we're still a little bit new to this, and I know we have some work to do there. Yeah, but I think our blog is a good place to start.
Yeah, no, I just dropped a link for everyone in the chat for the Medium and their website. And yeah, I mean, definitely reach out to Jim. He's a fantastic guy to talk to about all of this stuff. And he has a great network. So Jim, thank you so much. This was amazing. And I definitely appreciate all your insights and thoughts and everything. And let us know if there's anything that we can do for you. We are going to be, for everyone, we are going to be rolling out this ongoing funding application. So we've been doing some pitch competitions, and there's a lot of people in our network that are, interested in raising money and capital. So Jim, I'll send you the link to that as well. And on the back end, all the investors in our network can see the startups who are applying for funding. If there's any that are interested, we're more than happy to make introductions to, the startups in our network and whatnot. Yeah, if there's anything else, feel free to, feel free to reach out, but I really appreciate this. This was awesome. To all of you who stuck around, I know we have almost 40 people still on. I just dropped some links for Entre stuff, our website, to join and sign up. If you're struggling with raising money or any of that, please reach out to us, myself. I put my email there as well. We're more than happy to introduce you to, if it's a good fit, to investors like Jim or others within our platform. So I think that does it. So Jim, thank you so much. If anyone has any questions or thoughts, feel free to reach out to us, and everyone stay safe out there. If you're in New York or wherever right now with the hurricane, stay inside, and hopefully everyone's good. And thank you for joining. And Jim, really appreciate it. This was awesome.
Cool. Thanks for having me. Thanks, everyone.
Yeah, you got it. All right, everybody. Thanks so much. I'll see you.